Imagine standing at the center of a well-lit trading floor, where every tick of XRP's price sends ripples through portfolios and boardrooms alike. And ask the blunt question, can XRP really reach $30 during this bull cycle? The short answer is yes. It is within the realm of possibility, but only under a specific confluence of structural, legal, macro, and behavioral conditions. And no, it is far from guaranteed, because there are equally credible valuation, network activity, and profit-taking dynamics that could stop or reverse the run well short of that mark. To evaluate the $30 scenario honestly, let's weigh both sides from first principles and then turn those observations into measurable signals. In practical scenarios you can use to trade or invest with clarity. Start with the drivers that make $30 plausible. First and most visible is the legal regulatory arc around Ripple's litigation and the ETF narrative. If U.S. regulatory overhang diminishes decisively, for example, a favorable resolution or a definitive legal precedent that confirms XRP is not a security for broad classes of transactions, the pool of eligible institutional buyers swells dramatically. That shift would remove a multi-year risk discount that is priced XRP below many other major tokens and would allow exchanges, custodians, institutional products, including potential spot ETFs or tokenized instruments, to list and hold XRP. Without extraordinary compliance gates, market participants price forward-looking outcomes. The expectation of ETF approval or regulatory clarity can compress the discount very fast, and those flows can be large because institutional allocations come with scale. Historically, we've seen assets re-rate quickly when regulatory uncertainty clears and institutional channels open. The result can be parabolic appreciation in a compressed time frame. Second, tangible demand signals have already been present in the recent run. Massive exchange outflows, relistings, growing on-chain attention, and retail institutional interest have coincided with large percentage moves, gains of 1,000% plus over. Multi-year spans are not unprecedented in crypto, as the asset class history shows. If this cycle is led by durable, not purely speculative, demand, for example, tokenization of real-world assets on XRPL, corporate treasury allocations, or payment rails that actually route settlement volume via XRP, then token velocity, and real usage will validate price appreciation rather than merely reflect speculative momentum. Third, from a technical analysis standpoint, the classic double bottom retest narrative that some analysts point to is meaningful, a multi-year accumulation. A clean break above neckline and then retest to support is a textbook precursor to large trends in many assets. When you combine that with macro liquidity, loose risk-on flows, and concentrated short interest that can be squeezed, the mechanical path to multi-buck targets becomes plausible. Projections 2, $27 to $34 that use Fibonacci extensions measured. Moves and historical fractal comparisons are not mathematical certainties, but they are useful scenario anchors if the market behaves as it did in prior bull phases. So the affirmative case boils down to legal clarity plus real usage, institutional flows, plus favorable macro liquidity equals plausible runway to $30. Now, flip the tape and look squarely at the reasons that make the $30 target doubtful or at least conditional. The first and most immediate red flag is valuation relative to on-chain activity. When market capitalization outruns network usage materially, as the data you shared suggests, with XRPL's market cap many orders of magnitude above its TVL, or a transactional economic value, the market is effectively pricing an enormous amount of future adoption into today's price. That leaves the asset vulnerable to profit-taking and mean reversion if the adoption vectors take longer to materialize or if they disappoint in scale. Empirically, markets that decouple price from utility to FAR tend to correct as risk is repriced, or as traders realize the implied growth is too optimistic. Second, concentration of profitability among holders is a timing risk. When more than 90 to 95% of supply is in profit, you create a larger pool of potential sellers who can decide in unison to lock gains, and in crypto, profit-taking can be contagious. High realized profits percentages have historically preceded abrupt corrections because many holders set mental targets. And narrative euphoria often turns into synchronous selling as traders rebalance risk. Third, the expectation versus execution gap on institutional adoption in ETFs is not trivial. Headlines about high probability of ETF approval or corporate interest can move price well before the actual capital arrives. Approvals, product launches, and institutional on-ramps take time, compliance work, custody audits, and operational integration. If price is front-running those outcomes too aggressively, the gap between expectation and deliverable capital becomes the catalyst for a correction. When some institutions take a wait-and-see approach or delay deployments. Fourth, the XRPLs, comparative lag in developer activity in TVL, relative to other smart contract platforms raises strategic questions about whether the network's growth can scale fast enough to justify the kind of revaluation the $30 target implies. Tokenization use cases and institutional pilots are promising, but pilots that don't convert into broad, repeatable flows leave price vulnerable. Fifth, from a pure market structure perspective, highly leveraged positions and clustering of derivatives exposure near key levels can amplify moves both up and down. Squeezes can produce parabolic rallies, but they can also leave the market with stretched positioning that is brittle to any negative macro or headline shock. So while the upside is real, the downside is immediate and quantifiable. How do we turn these contrasting truths into a practical framework for action? Think in scenarios and signals. Scenario A, the path to $30, requires three things to happen in relatively short order: a clear legal win or a regulatory signal that meaningfully reduces institutional risk, repeated measurable growth in XRPL on-chain activity transaction, value, tokenized assets, custody inflows that justifies higher valuation multiples, and demonstrable, sustained institutional flows into custody or productized instruments ETF filings, followed by actual subscriptions, corporate treasury purchases, or custodial inflows recorded on-chain. In this scenario, you should see exchange reserves fall consistently, DEX and settlement volumes rise, and long-term wallets increase their holdings while short-term speculative flows diminish as a percentage of activity. Technically, you should also observe higher time frame confirmations, weekly closes above key resistance, narrowing of downside volatility, and expansion of volume on advances. Scenario B, the derail in range, is where regulatory optimism is incomplete rumor, but no decisive win. On-chain usage lags. Whales or early holders take profits into rallies. Here price chops in a wide range, and $30 is pushed further into the future. We'll see exchange balances wobble or even rise. Active supply and profit remains high, and volume patterns show more distribution than accumulation. Scenario C. The rapid blow-off and correction occurs if the rally is dominated by leverage and short squeeze mechanics alone. Price spikes. Derivatives positioning becomes crowded, then a macro shock or negative legal headline triggers a swift unwind, with heavy liquidations. In that case, the upside is transitory, and $30 is a distant statistical outlier.
Nice.
What are the measurable, high-signal indicators to watch to adjudicate these scenarios? Monitor exchange reserves and large wallet flows, prolonged outflows into custody is bullish. Watch XRPL economic activity metrics, real value settled, tokenized assets moving into production, TVL growth. Follow the legal docket and regulatory announcements. Anything definitive that clarifies XRP's status matters. More than commentary, and track derivatives, open interest, and funding rates for signs of overheated leverage. Sentiment indicators are useful as early warning signals when NVT or percent of supply and profit spikes to extremes. Historically, it foreshadows corrections rather than persistent rallies. Practically, for traders and portfolio managers, risk management must be explicit. Use staged exposures tied to milestone confirmations rather than one-off leverage-heavy bets. For example, allocate a base position to reflect a medium-term bullish view. Add on confirmed legal or institutional milestones. Consider hedging upside exposure with options or scaled sell targets if a large portion of supply is in profit. For shorter-term traders, trade the levels. If price holds above the neckline retest zone with expanding volume, treat that as evidence for momentum-based entries. If the market fails that support decisively with rising exchange flows, trim or hedge aggressively. Finally, a sober assessment of probabilities. $30 is not impossible. It is conditional and requires multiple boxes to be ticked. Legal clarity. Institutional flows that are real and sustained and measurable growth in XRPL, economic activity, to justify the valuation expansion. If those things happen, a multi-buck target becomes much more credible and necessary price discovery will follow. If one or more of these elements fail to materialize, then the risk of sharp corrections or prolonged ranges increases materially. In short, treat the $30 thesis like a high reward, high conditional bet. It deserves attention in staging and allocations. But it also requires vigilant signal monitoring and disciplined risk controls, because in crypto,